All right, here we go with the update on the volatility. We try to do this with a trade-by-trade basis so that you guys can see the dynamics of the person algo optimizer. As you know, we promoted the fact that the VIX had shorted the market, it covered the short, and then it went long. It's been trailing a stop, trailing a stop, trailing a stop. The stop function got clicked out on a downdraft here. So we have a new high in equity performance. So green level, and as you can see, this is a closed out trade. So the history of this performance on trading the VXX with the algo optimizer system has been a dynamic product. And as you can see with the equity curve, that's the new high for this program. So that's a new equity. Green dots signify on a scaling basis the performance cumulative equity curve line. So green dots signify new equity highs. It does have a period of, I guess you want to call this drawdown or inactivity, but what we have this programmed as is just specifically to take both sides of the trade on the volatility VXX ETN, meaning it does take shorts and it does take longs. Usually short only is sometimes a better opportunity because this product is designed to do nothing but a vol crush every month. If there is no dynamic shifts or in a equity bull market, the volatility will contract. So every once in a while you get a bear market and the volatility pops, and when it pops like that, you look as the volatility comes back, when rational traders come back, then you look to take sell signals. In a period that the market is at this 9-year high, we've seen volatility changing all the way around, so at this point it makes it better to take both sides of the trade and to see how its overall performance is doing, and that's what we use it for. We also use it for two other things that other clients like to use this for, to help measure that if it goes long, it might introduce the fact that the S&Ps might have some downside pressure. And now that it's flat, it's hard to gauge whether or not if it went short, and if it breaks down and then the system goes short, it would be my contention that the spiders, the S&Ps, are going back up to test their highs. And let's take a look at that theory as it is right now. This is the S&P 500 with the person's PPS indicator, and again, you can see that these are these horizontal lines are based on a calendar month. So you can assume, and you'd be correct, that these are the monthly person's pivot indicators. So this gives us the targeted support and resistance. So we have our buy and sell arrows, right? So it indicated a bearish before the big kahuna crash, generated a buy as the market had some upside, a sell signal before it went down, and it's still right now in a buy mode. These are the breakdowns of the advanced declines based on the S&Ps. So again, today our reading on the S&Ps is negative breadth, 118 to 382, if I can read that small print. The fuchsia chart here is the cumulative advanced decline on the S&P 500. Now, it's made a new high for the year where the equities did not make a new high. And it could lead to speculation if the market pulls back, bounces off support, and starts to take out this level high, which I have too many lines. The theory is, or what we would be looking for, if the market gets back above the resistance of those highs, and that advanced decline cumulative ratio continues to move, and the volume continues to move, we should see, believe it or not, a new high, or at least test the high in the S&Ps. So do you buy the pullback right now? Do you buy the breakdown here? No, because the market could just go straight down to heck in a handbasket. It's the end of the quarter, the Ides of March, in like a lion, out like a lamb. We would instead, if you're looking for a market to go up and it pulls back, you don't buy the pullback. You wait for the support to hold, and you look for the market to chop around, and you buy when the market's proving itself on a breakout of its trend direction, okay? So you'd buy on a as the market bounces and proves itself. You don't buy the pullback. So I wanted to just share with you, I'm not thoroughly convinced that the stock market is done based on the current pattern of the cumulative advanced decline. We still have a consecutive series of higher highs, and higher lows. And until we get a pattern of lower lows and lower highs, there's still a shock to the upside because so many people are now bearish the market that believe the top is in. There's a shot that we could see a sector rotation grind, not just into the financials, but also into energy stocks. So we have to and healthcare. So we got to look at what's heavily weighted on the market. Now, all this is predicated on A, the market supports, B, it doesn't break down any further. And then finally, we got to look at the condition of the market to make sure that the breadth of the market does not break down and volume doesn't start to really move lower. Now, on my charts, I've left the volume histogram because that's what a lot of retail traders are still using to this day. Why, I don't know. We try to teach a little bit more sophisticated methods to keep up with the, computerization age. Volume histogram is not an effective tool. I think, in my humble opinion, it should be outlawed. It gives a lot of false readings and false sense of security as far as the real cumulative trend of the market. But that will be saved for another time. What I wanted to point out to you is that current position on the VXX took another profit on the year. It's flat right now. And if you watch these sequence of videos that we've been doing, I've been alluding or sharing with you the results of this system as the conditions warrant. So when we had a new position get flat, I thought it would just be helpful and courteous to you who's been watching these videos to show what it's actually doing and how the trades are ending up. Now, let's look at a couple other little things today that is of interest. The bond market, something we wrote about over the last couple weeks, we've started to see an increase in volume longer term, and the algo system, one of the trades that we did in the trade room today, if you were in the room, this is a gray line of last conditional change. Now, the system had already been long a position, but it did get out near the high. Now, the funny thing is what you do not see on this chart are the person's pivot indicator. I'll try to put that up for you right now. So here's the irony. The system had nothing to do with taking a profit near pivot resistance. It's just that the max profit target, it says the profit target, generally speaking, here's another one yesterday, went long the market. All of a sudden, what's funny is the market bonds have started to take more buys over the last week than sells. And one of the reasons is because the market dynamically is shifted and is in what we would consider a short squeeze play. When we take a look at the weekly thoughts and observations, some of the things that we've been pointing out, and I'll share that with you right now. So I just brought this into one of the data metrics that we look at is the COT data. And it did show that hedge funds increased their long. However, they added to their shorts while they're still net long. That's the hedge funds, the professional traders. Commercials are also net long. So you got two groups, banks, institutions, hedgers, and professional traders that run managed funds. Two groups long while the small spec short. So who do you think is going to win on this one? My take is that rallies are used to addition new shorts, which will limit upside moves, but we are looking for, and we talked about this tri-star doji pattern on TBT, which we could see as potentially a stall pattern. TBT tracks yields, bonds track price, and they're an inverted relationship, meaning when yields go down, when interest rates go down, prices go up. So when TBT goes down, then prices go up. Let's take a quick look at that because this is another thing that we focused in on our trading room. So we'll go over here to our trading system. The first thing I'm going to type in is TBT. And this is what a tri-star candle formation is. They're very rare. We barely see them ever. And this is the tri-star that we wrote about this week. 3 dojis in a row, tri-star. This is a weekly chart, gang. And, I always like to see markets and pay attention to dojis when they don't exist in any other markets. A close on a weekly basis above that high or below that low. above the high signifies that the market's going to have a continuation. A close below that suggests we're going to have a breakdown. So the TBT, we are right now, Wednesday, if the market closes where it's currently at, it would signify that there would be more upside in bonds. So let's go and take a look at the bond chart right now real quick. And a couple things that we were going to look at is just like I pointed out to you in writing on the weekly thoughts and observation. You can see it in a pictorial view right here. This is the Commitment of Traders report. And you'll notice the blue represents the commercials. Excuse me, the blue is the hedge funds, the red is the commercials, and the yellow are small speculators. Small speculators have the largest net short position that we've seen in darn close to 3 years. Last time you had a combination where the small specs were short and the commercials and the hedge funds were long. Again, two groups versus one, was when the market was at a low before it rallied. So just thought I'd case in point, we could see more upside. We are right now at a threshold of a weekly PPS buy signal. So even though it's Wednesday, it's alerting us. If on Friday the market closes here or higher, it's going to generate a weekly buy signal, and we should see a launch and a liftoff, I would guess, as a short squeeze against that group, the small speculators. And if you look at when they started to build their short position, they started to build their short position between 148, 149. The market came down. How much is going to be liquidated to squeeze them out of their short positions? Probably 147. A low here up to 147. Gang, that's about a $6,000 to $7,000 per contract move against them. That's a enormous threshold of pain that not many small speculators can financially survive through. So will it happen? We don't know, but we're on guard for it because it's what we've predicted and warned everyone that we could see a short covering squeeze. I think upside will be limited. I don't think we're going up to 160. I think we'll be more likely to get to that 146, 147 area, and that should do enough financial damage to the small speculators who are short. I hope you enjoyed watching this just to show what the indicators are pointing out to, and it's also the Ides of March. In like a lion, out like a lamb. We have quadruple witching coming up on Friday, so all of this could be a part of factor of what's going on in the marketplace. Thanks for watching. I hope you found value out of how we put together specific technical trading tools and how the Algo Optimizer is really kicking some serious butt. Thanks.